Go.
This is Group 9. My name is Virungi Rachel.
My name is Susan.
Ankunda Precious.
No, Emojit.
Uganda, like any other country, is undergoing inflation. Inflation is the general increase in the prices of goods and commodities. Some of these commodities include cooking oil, soap, fuel, among others. For the current situation in the government of Uganda has come up with two policies, that is monetary policy and fiscal policy. A policy is a principle of action brought about by an organization or individual, which are going to be explained.
Monetary policies are actions undertaken by the central bank of an economy to control money supply and achieve stable economic growth. This can be done through macroeconomic objectives like moral suasion, open market operations, direct lending, reserves, currency reforms, while fiscal policy is the way how the government adjusts its spending levels and tax rates that influence the country's economy. This can be done either using expansionary policy or contractionary policy.
The government can apply the monetary policy to curb the increasing rate of inflation in Uganda today using the following tools of monetary policy. The open market operation. This is where the central bank sells the government securities to the commercial banks. Selling the government securities to the commercial banks will reduce the cash holdings of the commercial banks, therefore discouraging borrowing by the public. And this will reduce the amount of circulation, therefore reducing the prices of goods in the country. Then the bank rate policy. This is the rate at which the commercial bank borrows from the central bank. If the central bank increases the bank rate policy, if the central bank increases the bank rate, it will discourage the commercial bank from borrowing, therefore reducing the amount of money in circulation that will help in reducing the inflation. Then the reserve requirement. This refers to the money the commercial banks must keep with the central bank. Therefore, a high reserve requirement will help the central bank to control inflation, since it gives the commercial banks less money to lend out to the public, which will reduce on the money supply and therefore reducing on the prices of the goods. The discount rate. This is the rate at which the central bank charges the commercial banks to borrow at its discount window. Therefore, if the central bank increases the discount rate, the cost of borrowing for the commercial banks also increases, where they will increase the interest rate on the borrowing to the public, which will reduce on the money supply, hence reducing the prices of goods. The moral suasion. This is a roundtable discussion between the central bank and the commercial bank, where the central bank gives the directives and the guidelines on how the commercial banks are supposed to give out credit to the public. So if the central bank instructs the commercial banks to reduce on the credit given to the public, it will reduce on the amount of money in supply, therefore reducing the amount of goods.
Now, monetary policy has positive and negative effects. Positively, it can bring out the possibility of more investments coming in and consumers spending more. In monetary policy, where banks are lowering their interest rates on loans and more business owners, they would be able to be encouraged and to expand their ventures, as they would have more available funds to borrow with affordable interest rates. It can also lead to lower rates of mortgage payments. As a monetary policy with lower interest rates, it would also mean lower interest rates, which would mean lower payments to homeowners. Now, it can also promote low inflation rates, whereby it can help to promote stable prices, which are very helpful in ensuring inflation rates which will stay low throughout the country. Now, negatively, there are limitations of monetary policy. large non-monetized sector. There is a large monetized sector, as we all know, which hinders the success of monetary policy in such countries like Uganda and Tanzania, Kenya inclusive. Monetary policy mostly lives in rural areas where barter trade is practiced. Consequently, monetary policy fails to influence this large segment of the economy. Also, there is undeveloped money and capital markets. Now, the money and capital markets are undeveloped. These markets lack in bills, stocks, and also they share limited resources, which limit the success of the monetary policy. There is also high liquidity, whereby people want to keep money in their pockets. The majority of the commercial banks tend to possess high liquidity, so they are not influenced by the credit policy of the central banks.
Okay, just like any other country that is using monetary policy, Uganda should embark on using that. And from the experience of other countries, like Tanzania, has been using monetary policy to control inflation and promote economic growth, which is what any other country should embark on. Not only Tanzania, but we have Kenya, which is using the same policy to promote economic growth and control inflation.
In conclusion, Uganda should use monetary policy to bring about economic stabilization, because we have seen it being used in other countries like Kenya, Tanzania, USA, UK. Thank you.